Are you ready to protect your portfolio from the next big market trap? In today's video, we're diving into 3 overhyped stocks you need to avoid in August 2025. These are companies with sky-high valuations, shaky fundamentals, and potential catalysts that could send their prices tumbling. Stick around for detailed data, expert analysis, and tips to keep your investments safe. Now, let's dive in with our first stock. First up is Palantir Technologies, ticker PLTR, a data analytics company that's been a darling of the AI hype train. Palantir's stock has surged 66.4% year-to-date as of July 2025, driven by excitement over its Gotham and Foundry platforms and its new AI platform. But here's the problem. The numbers don't justify the hype. Let's start with valuation. Palantir's forward price-to-earnings ratio is sitting at a staggering 75x, far above the tech sector average of around 25x. This means investors are paying a premium for every dollar of expected earnings, banking on explosive future growth. But when we dig into the fundamentals, cracks start to show. In its most recent earnings report, Palantir posted revenue of $678 million, up 27% year-over-year, which sounds solid. But that growth is slowing compared to previous quarters, and the company's operating margins remain thin at just 12%. Compare that to other tech giants like Microsoft, which consistently deliver margins above 30%. Palantir's heavy reliance on government contracts also raises concerns about scalability, as these deals are often lumpy and unpredictable. Now, let's talk about downside catalysts. Analysts have flagged Palantir's AI platform as underwhelming so far, failing to deliver the game-changing results investors expected. If the next earnings report in August shows continued deceleration in commercial revenue growth, or worse, a miss on estimates, the stock could take a hit. Plus, with insider selling picking up, as reported by Bloomberg, there's a signal that even company insiders might be cashing out at these lofty valuations. The takeaway? Palantir's AI story is compelling, but its sky-high PE and slowing growth make it a risky bet right now. If you're holding PLTR, consider trimming your position before August earnings. Next on our list is Arista Networks, a leader in cloud networking solutions. Arista's stock has climbed 40.4% year-to-date, fueled by optimism around its AI-driven Ethernet switching platforms and a projected $60 billion addressable market. But here's why you should be cautious. Arista's forward PE ratio is currently 41.5x, well above the networking industry average of around 20x. While Arista has delivered strong revenue growth, $1.54 billion in its latest quarter, up 15% year-over-year, its valuation assumes near-perfect execution in a highly competitive market. Companies like Cisco and Juniper Networks are ramping up their AI networking solutions, which could erode Arista's market share. The fundamentals also raise red flags. Arista's operating margin, while healthy at 38%, has been flat for the past 2 quarters, suggesting limited room for further efficiency gains. More concerning is the company's reliance on a few key hyperscale clients, like Microsoft and Meta, which account for nearly 40% of revenue. If these clients scale back spending due to economic uncertainty or shift to in-house solutions, Arista could face a revenue shortfall. Looking at potential catalysts, JP Morgan recently noted that macroeconomic volatility, including tariff risks and a potential recession, could dampen enterprise spending on networking infrastructure in the second half of 2025. If Arista's August earnings show weaker than expected guidance, or if analysts issue downgrades, the stock's premium valuation could collapse. Arista is a strong company, but its stock price is banking on flawless growth in a tough market. For now, it's one to watch from the sidelines. Our final stock is Fluence Energy, a global energy storage company that's been struggling to live up to its early promise. Fluence stock is down 57.7% year-to-date as of July 2025, but it's still trading at a forward PE of 50x, which is steep for a company with such weak fundamentals. Let's break it down. Fluence's latest earnings report was a disaster. Revenue dropped 49% year-over-year to $680 million, missing consensus estimates by nearly 50%. The company also slashed its full-year revenue guidance by 15% in February, followed by another cut in May. These misses triggered multiple analyst downgrades, with firms like Goldman Sachs and Morgan Stanley citing concerns over execution and market demand. Why the weakness? Fluence operates in the highly competitive energy storage sector, where pricing pressure and supply chain issues are squeezing margins. Its gross margin fell to just 8% in the latest quarter, compared to competitors like Enphase Energy, which maintain margins above 20%. Fluence's balance sheet isn't helping either. Its debt-to-equity ratio is 0.8, high for a company burning cash to fund growth. The biggest downside catalyst is Fluence's upcoming earnings in August. If the company reports another revenue miss or further guidance cuts, the stock could slide further. Plus, with the energy sector facing headwinds from rising interest rates and tariff uncertainty, as noted by JP Morgan, Fluence's growth story is looking shaky. If you're holding Fluence, it might be time to cut your losses. This stock's valuation doesn't match its reality, and more pain could be coming. So, there you have it, 3 overhyped stocks to avoid in August 2025. Palantir Technologies, Arista Networks, and Fluence Energy. Each of these companies has an inflated P/E ratio, weak or risky fundamentals, and potential catalysts like bad earnings or downgrades that could tank their prices. The stock market rewards patience and discipline. Don't get caught up in the hype, stick to companies with solid fundamentals and fair valuation. Thanks for watching, and I'll see you in the next one.